Stop overthinking your investments. I used to believe the more stocks I owned, the safer I was. But the truth is, it just made things more confusing, more tracking, more noise, less focus. So I simplified everything. I stopped using complicated strategies. I narrowed it down to a handful of solid, reliable dividend payers. And for the first time, I actually felt in control of my strategy. I'm not going to waste your time. In this video, I'll show you a new strategy that has been working for me, the dividend stocks I trust the most, and how this small shift changed everything for me. I'm not a financial advisor. This isn't advice, it's just my personal experience and what's been working for me. The strategy I'm about to share isn't complicated. In fact, it's one of the most overlooked approaches in investing. It doesn't come up in most conversations, even though it's worked for countless investors over time. Every part of this video builds on the last, so if you skip around, you might miss the part that ties everything together. Let's dive in. JP Chase was the first dividend stock I added to my portfolio, chosen for its stability and reliable dividend history. There's a reason this isn't just a random stock pick. JP Chase isn't just a bank. It's a financial fortress that controls $3.7 trillion in assets, making it the largest bank in the U.S. When you think of American banking power, you're thinking of JP Chase. This isn't some regional lender hoping to make it big. This is the bank that other banks look up to. Since 2010, JP Chase has delivered a total annual return of approximately 18% when including dividends reinvested, outperforming the S&P 500 over that period. Here's what made me a true believer. During the 2020 pandemic crash, when fear gripped the markets and JP Morgan briefly dropped to around $76, the company didn't just survive, it recovered and surged to new highs within 18 months. This reinforced everything I was learning about long-term resilience and strength. Before I invest $1 in a dividend stock, I first weigh their moat, and JP Chase matches it perfectly. This isn't just a bank, it's a fortress. With over 200 years of history, a global presence, and deep integration into both retail and institutional banking, JPM has built a competitive edge that's nearly impossible to replicate. From its dominance in consumer banking to its leadership in investment services, asset management, and credit markets, JP Morgan doesn't just survive, it sets the pace. The brand trust, the technology, the regulatory relationships, and the scale, all of these form a wide moat that gives it pricing power, resilience, and staying power during economic downturns. And when it comes to dividends, JP Morgan delivers. With a consistent dividend payout and a track record of increasing dividends over time, this is the kind of stock that not only rewards me today, but grows my income over the years. That's why before I even look at the yield, I ask, is the company built to last? With JP Chase, the answer is a strong yes. But JP Morgan was just the beginning. The next dividend stock was a company that fundamentally changed how I think about dividend investing. Realty Income, which I now call my monthly money engine. This single investment taught me the true power of consistent and reliable income. I've seen plenty of high-yield stocks fall apart over time, usually because there was no real moat. But Realty Income is different. It's built to last, and that's why I added it to my portfolio. Realty Income owns over 15,000 single-tenant commercial properties across the U.S., United Kingdom, and 6 other European countries, making it one of the largest and most diversified real estate investment trusts in the world. But this wasn't just about size, it was about the quality and stability of what they owned. Every property is leased to high-quality tenants under long-term contracts, creating a predictable income stream that flows directly to shareholders. The performance numbers were incredible. Since 1994, Realty Income has delivered average annual total returns that consistently outperformed both the broader real estate investment trust market and the S&P 500 over long periods. Here's where things got truly remarkable. Realty Income has increased its dividend for 94 consecutive quarters. That's over 23 years of uninterrupted monthly dividend growth, paid out consistently, month after month, year after year, through recessions, recoveries, and everything in between. They've never missed a beat. Their tenant roster reads like a who's who of American retail and business. They own properties leased to major brands like Walmart, Home Depot, Walgreens, and Dollar General, along with hundreds of other well-established companies. The average lease term is about 10 years, with many agreements including built-in rent escalations. But Realty Income isn't just collecting rent, they're building long-term partnerships with some of the most successful businesses in the U.S. Realty Income is known as the monthly dividend company. The yield hovers around 5% to 6%. That's steady income I could count on, arriving as predictably as my utility bill. The most interesting part that no one really talks about is how Realty Income has built one of the most dependable income streams in the entire stock market. For decades, they've kept occupancy rates above 98%, a reflection of both the quality of their properties and the trust they've earned from their tenants. Even in the heart of the 2008 financial crisis, when other real estate investment trusts were forced to cut back, Realty Income stood strong and raised their dividend. That kind of stability isn't just impressive, it's comforting. My dividend journey shifted gears when I came across something a little different. A company that not only pays consistent income, but also fuels innovation behind the scenes. Hercules Capital, ticker HTGC. To me, it wasn't just another stock. It felt like investing in the engines behind tomorrow's breakthroughs. I started calling it my innovation financier, because while it paid me dividends, it was also helping startups and tech leaders scale. High yield means nothing without stability. Hercules Capital's specialty in venture debt is what gives it staying power. Hercules Capital is the largest specialty lender focused on venture capital and growth stage companies in the technology and life sciences sectors. But here's what makes them stand out. They're not the usual lenders everyone knows. They're the bank for innovation, stepping in to provide critical funding where traditional banks often say no. Their portfolio includes over 200 companies, but not just any companies, the ones pushing the boundaries of what's possible in tech and biotech. These are the startups building tomorrow's breakthroughs, and Hercules is getting paid to be part of it. Hercules Capital operates at the intersection of venture capital and traditional lending. They provide senior secured loans, mezzanine financing, and equity investments to high-growth companies. Their sweet spot is companies that have already proven their business model but need capital to scale. They're not gambling on unproven startups. They're financing the next generation of successful companies. What impressed me most was their disciplined approach. They don't gamble on unproven startups. Instead, they provide smart, scalable capital to businesses that have already gained traction and need fuel to scale. Their loan portfolio consistently generates net investment income that covers the dividend, and with default rates well below industry averages. Thanks to disciplined underwriting and active oversight, they've built a reputation for managing risk without sacrificing returns. When I first started tracking Hercules Capital back in April, the stock was trading around $15. As of the time I'm making this video, it's climbed to $18, a clear sign it's been heading in the right direction. This combination of high income potential and exposure to innovation, all wrapped in a strategy that values consistency over chaos, made it an ideal addition to my dividend portfolio. Hercules Capital typically yields between 9% and 10%, making it one of the highest yielding stocks I've found. They pay dividends quarterly, with a history of special supplemental dividends in strong quarters. They've maintained their dividend through multiple economic cycles, including the 2008 financial crisis and the 2020 pandemic. The fourth dividend stock in my portfolio is Trinity Capital, a newer but rapidly growing company that has established itself as a rising force in the venture lending space. Founded by industry veterans, Trinity Capital has been operating since 2008 and became a publicly traded business development company in 2021. Trinity Capital's business model centers on providing senior secured loans to venture capital-backed companies, with added upside from warrants and equity investments. They focus on firms that have moved beyond the startup stage but aren't quite ready for traditional bank financing. And their portfolio spans some of the most innovative companies in tech and healthcare. What attracted me to Trinity Capital was their attractive dividend yield, typically in the 8% to 13% range. Despite being a newer public company, they've delivered steady quarterly dividends, and management has emphasized a strong commitment to long-term sustainability. Their dividend is supported by consistent net investment income and a disciplined payout ratio that leaves room for growth. Since going public in 2021, Trinity Capital has moved quickly to build a diversified portfolio of over 100 high-growth companies across sectors like tech, life sciences, and clean energy. This rapid growth, combined with their experienced management team and focus on quality investments, made them an attractive addition to my income-generating portfolio. They're not as established as others, so there's risk, but I'm betting on their strategy because I believe the future is bright for this company, just my personal opinion, not a recommendation. When it comes to dividend investing, everyone talks about the big names, but I discovered one that was quietly delivering me good income. Procter & Gamble, the undisputed king of everyday essentials. From baby care to cleaning products, Procter & Gamble is everywhere, and they've been rewarding loyal shareholders for generations. They operate in 180 countries and serve nearly 5 billion people worldwide. Think about that. Almost 2/3 of the world's population uses their products regularly. Let's be real. I use PG's stuff all the time without even noticing. That's the moat, when a company becomes part of your daily routine. There's something rewarding about getting paid dividends from a company whose products are already in my home. The reason this stock became a favorite of mine is that Procter & Gamble has built some of the strongest consumer brands in the world. Tide has been America's #1 laundry detergent for over 70 years. Pampers is the world's largest diaper brand. Gillette dominates the global razor market. These market-leading positions generate consistent cash flows that support dividend growth. What impressed me most was how the company has successfully navigated digital transformation, emerging market expansion, and changing consumer preferences while maintaining profitability and dividend growth. In a world where consumer habits change rapidly, Procter & Gamble has proven its ability to adapt while maintaining the strength of its core brands. Let me tell you something, one of the most surprising moments in my investing journey was realizing that I could actually earn income from something as simple as people's love for snacks and soft drinks. That's where PepsiCo came in. It wasn't just a brand I saw on shelves, it became part of my income stream. Every time someone picks up a bottle of Pepsi, munches on Doritos, or opens a bag of Lay's, I get a slice of that moment in the form of a dividend. It made investing feel personal and a lot more enjoyable. PepsiCo is one of the world's largest food and beverage companies, with a diversified portfolio that practically owns America's cravings. Beyond the iconic Pepsi-Cola, they own powerhouse snack brands like Lay's, Doritos, and Cheetos, and beverage giants like Gatorade and Tropicana. Even though they sold their Tropicana majority stake to PAI Partners, PepsiCo's dividend growth story is impressive. They've increased their dividend annually for 49 years straight, with the current yield around 2.8%. The dividend has grown at an average rate of 7% annually over the past decade, faster than many consumer staples companies. PepsiCo isn't a get-rich-quick stock, it's a company I can invest in and sleep well at night. While the dividend isn't the highest, it's consistent, reliable, and backed by a strong moat. I'd rather take that kind of stability over chasing unsustainable high yields any day. This is a company backed by billion-dollar brands. In fact, over 20 of their products generate more than $1 billion in annual retail sales each. That's the kind of diversified and stable cash flow that supports reliable dividend payments year after year. So putting it all together, here's my portfolio results. I allocated equal amounts to each stock, creating a balanced approach that didn't rely on timing or speculation. Each company pays out a different amount. Some pay less but grow their dividend each year. Others pay more right away, but all contribute to a steady stream of income. Here's what my portfolio allocation looks like. From JP Chase, I receive steady quarterly payments that have grown consistently year over year. The bank's fortress balance sheet gives me confidence that these payments will continue even during economic uncertainty. From Realty Income, I get monthly payments that arrive consistently. There's something incredibly satisfying about receiving dividend income 12 times a year instead of just 4. It's turned my investment account into a source of regular monthly income. Hercules Capital provides some of the highest yields in my portfolio, and I love knowing that my dividend income is backed by loans to innovative tech and life sciences companies shaping the future. Trinity Capital, being newer to the public markets, offers attractive yields while giving me exposure to the next generation of high-growth companies. Procter & Gamble delivers steady and reliable growth with dividend increases that have continued for 67 consecutive years. It's the kind of predictable income that allows for long-term planning. PepsiCo combines growth with stability, and I appreciate knowing that my dividend is backed by one of the most recognizable consumer brands in the world. Together, these 6 positions generate substantial weekly, monthly, quarterly, and annual passive income. That's money showing up regularly, just for owning shares in good companies. Instead of hoping for stock price appreciation, I'm collecting real passive income that I can reinvest or use for living expenses. No investment strategy is risk-free, and this portfolio is no exception. Economic downturns could affect dividend payouts, especially from cyclical companies like JP Chase. Business development companies also carry higher risk due to their focus on growth stage businesses and increased leverage. Interest rate shifts can impact different sectors in different ways. Rising rates may benefit banks like JP but put pressure on real estate investment trusts like Realty Income. Consumer staples might see margin compression during inflation. Tax considerations and strategy. The tax treatment of dividends depends on your personal tax situation and the type of account the investment is held in. Qualified dividends from most U.S. companies typically receive favorable tax treatment, taxed at long-term capital gains rates rather than ordinary income rates. However, dividends from real estate investment trusts and business development companies are generally taxed as ordinary income, since they don't meet the criteria for qualified dividend status. This means that Realty Income, Hercules Capital, and Trinity Capital generate dividends that are taxed at higher rates. Holding dividend-paying stocks in tax-advantaged accounts like IRAs can help maximize after-tax returns by deferring or even eliminating taxes on dividends and capital gains. For taxable accounts, strategies like tax loss harvesting and timing of purchases or sales can help reduce the overall tax burden. The most important thing I've learned through this journey isn't about specific stocks or dividend yields, it's about mindset. The path to investment success doesn't require finding the next technology breakthrough or timing market cycles perfectly. It requires patience, discipline, and faith in the power of compound growth. I stopped trying to outsmart the market and started focusing on owning pieces of great businesses that pay me to hold them. Instead of checking stock prices obsessively, I focus on the quarterly and monthly dividend payments that arrive in my account. Instead of worrying about short-term volatility, I reinvest dividends and watch my ownership stakes grow over time. This approach has given me something more valuable than quick profits. It gives me peace of mind. I sleep well at night knowing that my portfolio is generating income from companies that have been paying dividends for decades through multiple economic cycles, market crashes, and periods of uncertainty. My advice to anyone starting this journey is simple. Stop overthinking your investment strategy. Focus on quality companies with long track records of dividend payments and growth and a strong moat. The compound growth that results from this patient approach is more powerful than any get-rich-quick scheme or speculative investment. I've put up a playlist for everything you need to build a portfolio you'll be proud of. Go check it out.